Put call ratio is still very high. High put call ratio is usually considered contrary and bullish. So again, nothing bearish here, I would say. Okay, students. Any further questions or any other observations you have? Are you doing your assignments? Working on it? Yes? Yes, students?
Yes, sir.
Yes, sir.
Chavi, can you present your idea today? Yes, no?
Idea is in the portfolio and IQ option.
Yeah, IQ option or trading view, whichever you are using. Yeah.
Okay, let me share it through phone only. I'll share with you one trade which I've done in Solar IND.
Yes. And Kirti, can you do?
Yes, sir. Once Chavi is done, I'll definitely do it.
Okay. So that we will keep in the second half of the session. No problem. Okay. Any issues you are having with any of those? You're okay with those, either one of those platforms, right? You're having no connectivity issues or anything, right?
Nothing from my end, sir.
Okay. All right. Then. So then we
Sir?
will get, yeah.
You said about the put call option or the ratio, right? It's high.
Yeah.
So what is the general normal ratio over there
Okay. So the
to consider it's
the
normal?
median, the middle one is just 1. Put call ratio will be 1 to 1. Typically in extremely bullish market, this put call ratio will always stay above 1. Yes, like how it is now. However, during the reversal time, suddenly if the put call ratio goes very, very high, then you will get reversal from up to down. So about when it crosses 1.7, 1.8 level, you should look for reversal. So similarly, when the put call ratio starts falling below 1, trend will be down usually. However, when it crosses below 0.5, reversal from down to up can come.
Okay, sir.
Is that clear?
Yes, sir. So we can generally use this also as an indicator.
Yes, definitely you can. But I wouldn't use it as a trading tool. I would just look it as an extreme points where there are market inflection points. I would use that. So when it is very oversold, and if the put call ratio goes below 0.5, then look for a reversal. Similarly, when it is very overbought, put call ratio goes above 1.7, be cautious and don't add further longs.
Okay, sir.
Any other questions, students? You have been able to use options, Opstra Edge to create your strategies and stuff? Yes, students? Yes, no?
Sir, I'm using Sensible for that.
You can use Sensible also. Yeah. I'm okay with that. Either one. So students, you are familiar with the assignment requirements, right? I'll just repeat that in case you are not knowing. Yes. In fact, let me go to classroom. So if you will click on assignment 2 here, okay, this is what I want you guys to do. But in addition to this, I think we have all assigned different companies to each one of you, right?
Yes.
Yeah, so you know which companies are assigned to you. You cannot submit the assignment on the same company, obviously. Each one has been given. So you actually have to say what the underlying trend is and develop strategies according to it. Come up with the maximum pain level. Just see, I don't want you to calculate anything. I just want you to get the information from the net and put it in here. And based on the trend of your stock, you have to design an optimal option strategy with a probability of success, which is pretty high. If it is close to 50% or more, then that is pretty good. The more the probability of success, the better. And use any one of the online strategy platforms for this. Is that fine?
Yes, sir.
So students, where did I stop? I think I discussed all the way up to straddle, yes? Last class?
Yes.
Okay. Okay, students. So we finished all these, and okay, students. Now, we already saw what a straddle was. A strangle is an extension of this. Remember, in a straddle, what did we do in a straddle? If you remember,
Selling, selling or buying the same premium.
so
Same
we bought a
same
put
strike
and a
price.
call, same strike price, right?
Yes.
So that is so the put and the call were at the money. Meaning if Nifty is 16,700, I will buy a put and a call of 16,700 strike. Close to that. Okay. And what is my aim? When do I think my straddle strategy will work? When I think the market is going to make a big move, but I don't know which way it's going to go. That is when. So strangle is also for a similar thing, but you are anticipating even a bigger move. So, but in strangle, the difference is you are going to buy an out of the money put and an out of the money call. So if it is 16,700 is Nifty today, I will buy a 16,800 call and a 16,500 or a 16,600 put. So when will I lose money or make money in this strategy? So if the Nifty were to stay between those two levels, strike prices, so 16,600 and 16,800. If the Nifty were to stay between these levels, I'll lose money on this time. But if it breaks out, which is our aim on either side, then I make money. Okay, so let's go to options edge. Buy strangle. Okay, so month end expiry. Okay, 16,100 put. So we say buy. You can see when we do this, your probability of success is very less. Yes, so this is strategy for next week, right? So the probability of success is very, very less. But if the market makes a big move, you probably collect quite a bit of money on that. This is just next week's expiry now. So let's do the reverse and say sell strangle. Let's say reset, strangle, strangle. Now look at the probability of success. Be very high. 68% chance. So what does this mean? There's a 68% chance that the market will stay between 16,450 and 17,000. Yes. Okay. Many people sell straddles. However, you have to be careful. Some event or any event like Ukraine war or something, and market can make a big move. So if you sell, you can suddenly lose a lot of money on one side. So that's the only thing you have to be careful about. But selling straddles, usually strangle, is usually the best way to make money in options trade. This is one of the best ways to make money in the options market. Okay. So you must also realize, where is my option? That as the strike prices get wider and wider, your chance of success are higher and higher, because likely the market will stay within that range. Yes? Any questions, students? So let me look for a video which explains this strategy. I saved one, I believe.
Hey, what's up, everyone? This is Kirk here again at Option Alpha, and tonight we are going to talk about the difference between using straddles versus strangles. We're going to do something a little bit different here because I like to draw and I like to use some of these like little whiteboards or papers that we're going to do. So in today's talk, obviously, the different two strategies that we're going to look at, we're going to do both kind of looking at the payoff diagram for each of these, and then also just kind of how you use each of these different strategies, because a lot of people have questions on how to use them, when's the best time, the whole deal. So we'll get into that here in a second. So what we want to do first is talk about straddles first, and straddles are probably one of the simpler option strategies to understand because it's basically just selling an at the money call and an at the money put. So your payoff diagram looks like this. If you're going to do a short straddle, you would sell the same short strike put and call. So it would be like, in this case, you would sell the 50 strike put and the 50 strike call. Now, the beautiful thing about doing a straddle is you collect a lot of premium because those options are worth a lot of money. So by doing the straddle and by selling those for a lot of money, that also moves out the break-even point, which is why you have this kind of pyramid shape here. So you might sell a straddle for, let's say, $350 when it's doing the at the money options. Now, a strangle, on the other hand, is selling an option that's out of the money on either end. So you'll be selling an out of the money put and then selling an out of the money call option. And you're going a little bit further out, and you generally have much wider break-even points, generally speaking. But because you're going further out, you collect less money. So this option, again, if the stock is trading at, let's say, $50, you might sell the 35 strike put and the 65 strike call or something like that, right? So you would go a little bit further out on either end, and in exchange for going further out and potentially having a higher probability of success, you might then collect less money. So let's say that this strangle here collects, I don't know, let's say just $1 to use round numbers, right? So it could be different for different stocks, but the whole idea here is that when you do a straddle, you're going to go at the money, really aggressive, try to maximize the premium that you've collected. And when you do a strangle, you're going to go a little bit further out and you're going to collect less money, but you're going to have potentially a little bit higher chance of success, okay? So those are the two main strategies there, and I can barely see the screen on my end because I'm writing on this thing. So if you guys have questions as you're joining in here, please let me know in the comment section, or definitely if you want to see other strategies or techniques. Now, the way that we generally use these option strategies, just so you can see how it kind of looks with the stock chart, but let's say that, you know, we have a stock that's just moving, right? And all we would want to do with the stock is to bracket it in some sort of profitable range, right? So that's what's different about options trading, at least the way that we do it, is that I don't care necessarily if the stock continues to go higher or from this point goes lower or sideways. Like, it doesn't matter at this point with a straddle or strangle, because your break-even points are out here much further than where the stock is trading at the moment. And so all we're trying to do here at this point is just take advantage of the fact that the stock could potentially trade inside of a 70 or 80% probability zone, right? So that's what we do. We'd sell a call option up here if we're doing a strangle, right? Or sell a put option down here. And by doing this, again, you give yourself a 70%, 80%, whatever you want to build. You build out whatever probability of success level you want to get to by selling these options, right? So that's the whole idea with doing this type of strategies. You're basically forcing the market to make an extended move in one direction or another that it won't generally make over time, right? And if it doesn't, then we keep that premium 70% of the time or more, right? We've actually found in most of our back testing that we keep that premium much more than 70% of the time. So when would you want to use a strangle or a straddle? I guess that's the question that most people have all the time is, what are the best times to use these types of strategies? Well, here's what we basically say, right? We basically say that when there is lower volatility, or IVR as we define it, when there's lower IVR, you generally want to go with the strangle. And the reason you want to do that is because you just don't want to be super, super aggressive selling premium.
Students, IVR is implied volatility. Okay. Implied volatility. When volatility is low, meaning the market is expected not to make a big move, then you sell straddles. However, when volatility is expected to move up, then you buy straddle or strangle. If the volatility is very low, then you can sell strangles. If it is moderately low, you can sell. When the volatility is moderately low, you can sell your strangle, straddle, etc. However, if the volatility is very, very, very low, you have to be a little cautious because suddenly it can turn and go up, right? So you want to be selling with near-term expiry. So anyway, he's going to describe all that. So
you can go with the strangle. You can go a little bit further out. You want to maximize your probability of success. And in exchange, you're going to give up a little bit of the premium that you could collect, but that's okay. When there's higher IVR or higher implied volatility rank in the market, higher implied volatility across the board, then what you want to do is you want to go ahead and choose the straddle. So you want to go a little bit more aggressive with your type of trading strategy so that if the market does see that quick drop in implied volatility, then your potential premium is going to realize itself much quicker. Now, people have an issue with the straddle because you're selling at the money options. They think, oh, that's too risky, or you're selling an option and it's one's in the money at all the time and could be assigned. But again, go back to some of the other videos that we've done. Assignment doesn't really happen most of the time until the week of expiration. So yes, you can technically be assigned at any time, but you're collecting a lot of money up front and you're going to try to maximize that time basically, or that potential profit much sooner. So you're going to capture that profit sooner, get out of the trade sooner, manage it sooner, whatever you want to call it, a little bit faster. So you collect more, but you also get more upfront, right? Now, what other people always have questions on, and this is one more thing before we end up here tonight, is how do I convert these strategies if I'm not in an account that can trade an undefined risk position, right? So many of you might even have that question, like, what do I do if I'm trading, if I want to trade a straddle or I want to trade a strangle, but I'm in an account that has an undefined, or that doesn't allow margin, doesn't allow me to do that. So here's what we're going to do, and I'm going to try to draw this on this top half here because I'm running out of paper. My daughter keeps stealing paper from me. But here's what you would want to do. If you are trading the strangle, if that's the basis of your position, and if you're trading in an IRA or risk-defined account, all you want to do is you want to go really far out on either end, and you want to buy these wings and create what's called an iron butterfly. So again, all you want to do is you want to go really far out, and you want to buy cheap options out of the money. So you buy a cheap call and you buy a cheap put option out of the money and create what's called an iron butterfly. So it looks like a butterfly position, but it's an iron butterfly because you're basically selling a spread on either side. Same thing with the actual strangle itself, right? So when you go ahead and do the original strangle and you're doing it undefined risk. You're just going to sell a call option above the market and a put option below the market. When you want to convert this, you're going to convert it into an iron condor by buying a cheaper put option below your short strike. And then on the top side, you're going to buy a cheaper call option above your original call short strike, right? So it creates this iron butterfly position. Now, in both cases, you're going to sacrifice a little bit of premium to do this, right? For sure. But again, you can't trade an undefined risk strategy in your account. So you've got to, basically make do with what you have, right? So sacrifice a little bit of premium for the sake of basically giving yourself a position that has defined risk, right? So you know exactly how much you can make, you know exactly how much you can lose, etc. So if you guys enjoy these videos, please let me know. I'd love it. And definitely want to get some thumbs up on here. Let me know what other...
Okay, students, do you understand what he's saying there? Yes, so he's basically talking about when to use straddle, strangle, and then convert it into an iron condor also. So iron condor we discussed last time in class. So it is a strategy for a non-volatile market. Yes. So let me go ahead and summarize for those who did not attend yesterday's class. So the iron condor basically involves, right, puts and calls. So when you sell the iron condor, so this is how it looks. Okay. So students, when do you think we are going to make the maximum profit? When do you think we are going to make the loss in this strategy? This was the last part of the video. He was talking about this iron condor. So basically, right, it is a sell straddle plus buy strangle. Okay. Iron condor is a combination of a sell straddle, right? A sell strangle, okay, and buy what? Buy strangle. If you combine a sell strangle and a buy, so you are basically selling a strangle like we did before, but you are hedging yourself with out of the money call and puts. So that's an iron condor. So now, when do we lose money on this strategy? When do we make money on this strategy? What do you think? Yes, students? Any idea, students? If you were to guess, what would you say? So we will make money, right? The green area of the graph. Okay. What does it mean? Look at the green area on the graph and tell me when we'll make money. I'm telling you that the green area is where we make money. So as long as we stay between the lowest strike price there, 16,400 and 17,000, we are okay. Yeah. So this strategy is good for next week, looking good for next week, I think. Even though the probability of profit is less, but you never know, right? For the most part, it looks good. But then the Fed can do something on Wednesday night and create a big move, and it could go on either side, right? So that's the really risky part. But anyway, so for most option, see, next week is expiry, so premium will come out. So to me, given that the maximum profit, max loss is like this, It's probably a good way to go, I think. Selling the iron condor. Is this buy or sell? We sold, right? Students, are you hearing me?
Yes, sir.
Okay. So what do you think? What do you think next week? You think the market will stay between 16,400 and 17,000? Can we say it may just do that? It may go up and down, but it may stay between that.
Yes.
Yeah. So, so I think this is a reasonable strategy here. Sell the iron condor. Now let's look at the payoff on buy iron condor. Now let's say I want to do this. So I say long. You'll see the probability of success is very, very low. No, actually the probability of profit is higher here. Okay. Interesting. I thought it would be the other way around. I guess it's saying. Okay, so you're doing the reverse. So, okay. So, but think about this for a moment. We are going to make money here when the reverse of what we did the last time around, only when the price goes above 60, below 16,400 or above 17,000, right? Interesting. So are option markets telling us that a big move is coming next week? Maybe. Sounds odd, right? Does it sound odd to you, students? That the strategy of success is actually higher here? Yes, no?
Yes.
Yeah. So maybe option markets are telling us a very big move is coming next week, guys. So watch out then. So beyond 16,400, below 16,400 or above 17,000. My goodness, crazy. So you see, sometimes option markets can tell you what the underlying market itself may or may not do, or what the option makers, market makers are thinking. Any observations, students? Any observations?
No, sir.
Okay. I mean, there are a few other option strategies. Okay, students, like Jade, Lizard and thing. I'm not getting into those. Those are a little bit more advanced, but you can play around with it and see. So remember, at the end of the day, when we are traders, we got to get into those options, strategies that make us money, right? So the only way that happens is by selling options. But you have to be careful though. You have to know the underlying trend of the market and sell in the direction of the trend. Okay. Now you must be worrying. We already saw what options, premiums, etc. are all on the, you saw the prices, option prices and all, we saw that. Now, how do these prices come up? How do we know that the options worth is this much. So for valuing stock options, we have option models. The most popular one is one which you have already done. Can any of you tell me? Kiran Bindu sir told me he has
Black
started.
Scholes.
Yeah, Black Scholes. So Black Scholes, William Black and Myron Scholes won the Nobel Prize for this because this model has been extended to several other things. So option premiums are usually calculated by Black Scholes. I'll just run you through it, right? And in fact, in my Excel download sheet, I have given you a sheet, a problem where the same problem is solved with Excel. So it's a lot more easier for you to do the options valuation. Just have a look at that sheet. Okay, so before that, there was something called a one-step binomial model. So there are some formulas on how you can calculate the values of the one model. So basically, the option premium is calculated using that formula there, of course. And we'll do a numerical and you'll understand. There's a one-step binomial model and then there's a multi-step binomial model. So I'll just walk you through how those mechanisms, but in real life, everything is done with the Black Scholes model. Students, I'll take the class after 5 or 10 minutes. Just need to take a break and then we can come back. Is that fine, students?
Yes, sir.
Okay. Okay, students, so we can continue. So this is how we will calculate the value of the option. So let's look at a situation. So this is an actual example. We will basically look at setting up a two-step binomial model. So basically you have to draw a tree kind of a setup. Okay, and then we'll use these formulas to calculate the value of the option. So remember, so basically we'll draw a tree like this because the stock price is moving up or down by 10%. And the outermost nodes, point F, point E, and point D, we will assume that expiry date has arrived. At points D, E, and F, at the outermost nodes, we will assume that expiry has arrived, which means what? There is no time premium on the option. There is only intrinsic value. Okay, students. Now remember the strike price is 21, and this is a call or put? Call, okay. Okay, students. So at the outermost nodes, it is very easy to calculate the option value. As I told you, there will be only time premium left. So when the stock is 24.2 at point D, 24.2 minus 21. That is how we calculate the at point E though, yes, the stock price is only 19.8, so it is expired, worthless. Yes, because the stock price is less than the strike price. And same as point F. So immediately we will write those values as 0. So once we know the values of D, E, and F, we will now use it to calculate the other values. So how can you do it? Payoff at point E, point F, and all those things. So you understand point E, F, and D, how the values come? Yes, students? Yes, no? Students, are you there?
Yeah.
Yes, sir, we are there.
Yeah, are you understanding how the values at D, E, and F are coming? If no, please say no.
No, sir.
Okay.
I'm sorry.
No problem. No is a very, very valid answer. So please don't hesitate. We as Indians always hesitate to say no, right? Because we think it will demonstrate our ignorance or something, but no is a very valid answer because these are complex topics and you must understand every bit of it, and every one of you must understand every bit of it. So in case you have not understood something earlier, also immediately stop me and we can go. Okay, so very simple question here. D, E, and F are at expiry, I said. Okay. And how do you calculate the value of the option? Call option? Intrinsic value. So there is no time value here. How do you calculate?
Difference between strike price and spot price.
So basically market price minus strike price. Okay. Or the stock price minus the strike price. What the strike price remains same for everybody. What is the strike price? The price at which the option can be converted to shares. Okay. So this is a 21 strike price. It is given in the question. Okay. Given in the question is 21. So at point D, we'll say 24.2 minus 21. Market price minus strike price, 3.2. So D you understood, right? Yes? Students? Did you understand the value at D? Yes, no? That's the first step. So how did I get that 24.2? It is given in the question. The stock price increases by 10%. Each time you do the problem for stock price increase of 10. So from 20, 10% is 22. And from 22, 10% is 24.2. Now is that clear? Yes, no? And from 22, 10% down is 19.8. From 20, 10% down is 18. And from 18, 10% down is 16.2. That is how those values, numbers come.
So, but
Is that-
why exactly 10%?
Because it is given in the question.
Okay.
So I'll show you now. Let's go back to the question. It can be anything, to be honest with you. But here, look, in each time, assume that there are 2 time steps of 3 months each. And each time step, the stock moves up or down 10%. Okay. And there is a strike price of 21. Call option. So these two numbers are very important. 21 and 10% given in the question. So we are only using that. Is that clear?
Yes, sir.
It can be anything like you said, but I am just using the values given in the question. So now you understand the stock price is given there.
Yes, sir.
And at point D, how the value of 3.2 came? So it is
Yes,
market price minus strike price. Okay. Are we clear on that? Yes, students? You are extremely quiet now. So tell me if so.
Yes,
If something is not clear, tell me what is not clear.
For me, yes, sir.
Okay, done. What about the others?
It's clear from my end for now, sir.
Okay. Sure. Okay. Now, what about point E? How do we calculate that value to be 0? So it is 19.8 minus 21. Of course, you can't have a negative value. So it's 0, right? Option value cannot be negative, right?
Yes.
Yeah. So at expiry, you can only have a 0 value. So this option is out of the money. At expiry, it expires worthless. So it is 0. Same for point F. 16.2 minus 21. You can't have negative value. It can only be 0 because it can go worthless at the most. Yes?
Yes.
Is that clear, students? Now we will use the formula. We will calculate point B. Point B is the intersection of D and E. So using the values at D and E, we will calculate the value for B. Similarly, point C, we will calculate the values using E and F. And finally, once we get point B and once you get point C, we will use that to calculate the value of A. Is that clear, students?
Yes.
Okay. Just logically understand. Okay. So now we will use the formula. Yeah. Don't worry about the exact formula. We will just the same formula which I displayed here. This formula we are going to use. First, we will have to calculate DD and DU. We don't have to calculate, it's given from the option prices. Yeah. Sorry, DU we should calculate and DD we should calculate based on the 2 nodes. And once you do that, we just plug it in the formula and we find a value of 0.65 for the P. Use the P value, and if you calculate it, you'll get the value of B as 2.03. B is calculated using D and E. Now we will calculate the value of C from E and F. Okay. And once we get the value of, okay. Now, what is the value of option C, you think? So option C, the value of the option at point C, okay, even though expiry date has not come, it's still 0. Why is that? Technically, some value will be there, but in this case, it is 0. Why? Because C is calculated from E and F. And since E and F are 0, C is 0. Okay, if you put it in the formula, it will come 0. Is that clear, students? Okay,
Yes.
now we know C's value, we know B's value, use that to get A using the same formula. No need to worry about the exact details of the formula, but logically understand how you get. So that's how we get. So this is the binomial model. Of course, the binomial model, some assumptions are there that is why you are getting, well, technically it is not that accurate of a model. And so hence we shifted to something called the Black Scholes model. Okay, students, so tell me about the Black Scholes model. Since you already know about it. Yes, students?
By using normal distributions
Yeah,
based on strike price and time to expiry,
yeah,
we'll calculate the options premiums.
yeah. So basically, we say that stock prices follow a log normal distribution. Okay. Uh, both the stock price and the option price, yeah, have subject to the same level of uncertainty. So how can we eliminate this? We can form a combination of the stock and the option. And basically you are, if you create such a portfolio, it becomes risk-free. So the whole concept of Black Scholes is based on certain underlying assumptions. Okay. So this is the Black Scholes formula. Yes, am I correct?
Yes.
Yeah. So most of these things can be calculated easily in Excel. Have you calculated in Excel before?
Yes.
Okay, so you guys know how to do it. So no problem. Okay. So this is familiar to you. Okay. So the important components of the Black Scholes model are this: stock price today, life of option. So this sigma, which is the volatility of the stock price, is very, very important. So when volatility is high, option premiums will be high. Okay. When can volatility be very, very high? Right now, volatility is very, very low. The Indian market index Nifty, so volatility has crashed like anything. Okay. So option premiums are not that high technically right now. So that makes me think that given volatility is so low, given the macroeconomic backdrop, some bad thing may happen very soon and push volatility very high. Okay, so this is what I was referring to you when I said the volatility is very low. Look at the India VIX index. This has crashed like anything. You would think the reverse is true, should be true, right? But crazy. But on the long-term chart, you can see how this is still coiling up for a very, very big move. Yes, so it is after a period of volatility, it is coiling up. It is breaking down, but if it breaks up, then it can push higher. So it's a very interesting junction here. But you can see it is near the lows. And it is much lower than the US volatility index, which you can see on the right side of your screen, 23. So with the rupee crashing and a recession coming, I cannot understand how volatility is this low. Any theories, guys? Why volatility is this low?
Don't know.
Yeah, it's crazy. I don't understand what's going on here. But my guess is I think volatility is going to go up again in the not too distant future. But anyway, that was a digression from the topic. So the reason I brought up volatility is that it is an important element of option pricing. Okay, Okay, so you can use an example here and find the value of a call option or a put option. Yes, using that Black Scholes formula. And you can do it very easily in Excel, like I said, D1, ND1, etc., etc. So if you do that, I've calculated both call and put options. Yes, and I think we did this here. So all the class problems here are given to you, students. You can look at all of those. And this is the Black Scholes question right here. So this is our strike price. So it's just a lot of feedback into this, feedback into this. So the only thing you need to know is the formula in Excel for the normal distribution. So you have to put this formula in and calculate this. Okay, students. So that normal distribution formula you should use. So you have done this in Excel, this type of stuff, right?
Yes.
Okay. Okay, so implied volatility, like I told you, is very, very important for option pricing. When implied volatility is more, option prices will obviously be more for both puts and calls. So implied volatility is a very, very, very important metric of option prices. So very interesting graph here. This is the 2008 recession. You can see how implied volatility came very low, and then right in October it started going through, and it went when almost the full subprime crisis happened. The implied volatility, the US volatility index went up to 80. So I think we are in a very similar situation. After the recession was getting over, it crashed again back low. So the point is, very interestingly, this time around, with all the Fed raises, implied volatility has not gone up at all. That makes me worry that some unforeseen event may happen. Okay. Okay. Any questions, students?
No, sir.
Okay. Now let me see if I can find you a video on this. I think I've so this is a good video. Let's have
In this video, we're going to take a look at using the Black Scholes option pricing model to value options. Now, in order to follow along this video, it's probably worthwhile to stop, pause the video for a second, and go get a couple of files that I posted up on Google Docs. I use the tiny URL to keep the address a little bit smaller, but if you go, the Brocker-standard normal table is just a standard normal distribution table that we'll use as part of the calculation. The BSOPM file is just a formula sheet with the Black Scholes option pricing model formulas on it. And the last is a spreadsheet. After we walk through this by hand, you might find it's a lot easier to use an Excel spreadsheet. If you want to do that, this spreadsheet that I made up walks through the Black Scholes option pricing model. You plug in the inputs and it spits out the value of the options, as well as some other information that might be useful as you get into options analysis. So if you want to pause right now, go get those files, and then come back, we'll start the video. Now, when I started this video, first thing I did in the setup was take a look at some current option prices. And this video was made around early June 2011. And I went and looked June 4th at Netflix. Netflix was currently trading for $273.40. And you can see the different options, some calls and some puts, widely different prices. Where do those prices come from? How do traders decide what's a fair value to pay for an option? One of the basic models is the Black Scholes option pricing model, and that's what we're going to walk through in this video. Now, as we discussed in a previous video when we talked about intrinsic value and speculative premium, option prices are a function of 5 factors: the underlying stock price, the exercise or strike price for that option, the time to expiration, the volatility of the underlying stock, and the risk-free rate of interest. And those are the 5 factors that are going to go into the Black Scholes option pricing model. So we're going to take all 5 of those factors and use the Black Scholes option pricing model to figure out what the option is worth. We're going to start with the value of a call. Now, the formulas for the value of a call look pretty messy, and the Black Scholes option pricing model was developed using stochastic calculus. I've actually seen the proof and walked through it once before, but mathematically it's a little bit beyond my skill level, so just let's trust these guys and assume that all these formulas are valid. We start with the value of the call, which takes the stock price times an area from the standard normal distribution table minus the exercise price divided by E to the risk-free rate times time. Now, this looks like a big mess here, but really all that is a present value. It's the present value of the exercise price discounted back to today at the risk-free rate of return. The difference between this and normal discounting that you might do on a financial calculator is Black Scholes used a continuous discounting model, so this E stands for the exponential. And then we take this multiply by ND2, which is another area under the standard normal distribution table. Now, in order to get D1, or the value of the call, we need D1 first. And so we've got a formula for D1 that looks like this. It's the natural log of the current stock price divided by the strike price plus the risk-free rate plus 0.5 times the standard deviation of the underlying stock squared, all that times time divided by the standard deviation times the square root of time. Now, a couple things I want to mention here. First, whenever you see this T for time in the Black Scholes option pricing model, it's going to be the number of years. So if we have an option with 1 month to expiration, that's 1/12 of 1 year. So we always have to plug that in as the number of years. Typically it will be less than 1, and it will be some fraction or a decimal. The other thing is the volatility. Now, we don't know what that volatility really is, so this is our best guess of how volatile the stock is going to be over the upcoming time period. But we want to make sure we plug that in as a decimal. So if we forecast a standard deviation of 25%, that would go in as 0.25. And our last formula, finally have something relatively short, D2, and that's used up here in the second half of the value of the call formula. That is just D1 minus the standard deviation times the square root of time. Now, in order to walk through the Black Scholes option pricing model, the best way is to set up an example and go through that. So let's start with an example. We've got a stock that's currently valued at $62, so our stock price is 62. That's the P0 in our formulas. The exercise or strike price is $60. Since we're looking at a call, this option is currently in the money. If it expired today, we would exercise it. It has an intrinsic value of $2. So we know the value of the option is going to be higher than $2. But how much higher? What is the speculative premium that should be attached to this option? That's what we're going to find with the Black Scholes option pricing model. Time to expiration is 40 days. Now remember, this is fraction of a year, so when we plug that into the formula, it's going to be 40 over 365. 40 days out of 365 days per year in order to set up time. Volatility, 32%. And again, when we plug that in to our formulas, it's going to be 0.32 and the risk-free rate of 4%. And when we plug that into our formulas, it's going to be 0.04. So our percentages have to be plugged into the decimals or into the formula as decimals, and time should be as a fraction of a year. Now that we have that set up, let's go through the calculations. When we set up our initial D1, you'll see the formula here, the natural log of this current stock price divided by the strike price plus the risk-free rate plus 0.5 times the standard deviation squared times time divided by the standard deviation times the square root of time. Now it's just a matter of getting out your calculator and walking through these calculations. Take 62 divided by 60, press the natural log button on your calculator, you'll come up with 0.03279. 0.04, just carry down. 0.32 squared times 0.5 gives us 0.0512. And 40 divided by 365 is going to give us 0.10959. Now 0.32, 40 divided by 365, take the square root, gives us 0.33104. So all we're doing is we move down this step, it's a little bit of the calculations. Again, more calculations. Taking 0.04 plus 0.0512 gives us 0.0912 times the 0.10959, and our 0.32 times 0.33104 gives us 0.10593. Last step, add all this up, we get 0.04279, divide by the 0.10593, and that gives us 0.404. So our D1 is 0.404. Now we need D2. D2, remember, was our much simpler formula, just D1 minus the standard deviation times the square root of time. So we've got D1 here, what we solved for in the last page, times the standard deviation, or minus the standard deviation times the square root of time. Again, just go through the calculations. 0.404 minus 0.10593 gives us 0.298. Now we're going to have to look these values up under a standard normal distribution table. And the standard normal distribution table that I've set up carries everything out to 2 decimal places. And you might have went and printed that out from Google Docs. You can see here what we've got. Standard normal distribution table. We've got column of D's, column of ND1s, and we want to find 0.40 and 0.3. So if we look at that, 0.40 on this gives us a value of 0.6554. 0.30 gives us a value of 0.6179. So those are ND1 and ND2. Once we have those, now we can go back to the value of the call formula. If you remember when we introduced the formulas, we said that the value of the call, let me just find that formula here real quick. The value of the call was equal to P0 times ND1, which we've now looked up, present value of the exercise price, and ND2. So we set those in, P0 times our ND1, present value of the exercise price is 60. To get the present value, we take the risk-free rate times time, press the E button on your calculator. It's referred to as the exponential. Should be a little italicized E somewhere on your calculator, or something like E to the X. So figure out what X is, and then press your E to the X button. And then we multiply by ND2. Go through the calculations. 62 times 0.6554 is 40.63. Our exponential is 1.004393. So 60 divided by 1.004393 gives us 0.6179, or 59.74. Now here's a little tip. Sometimes I have my students do this so they can see that there's nothing mystical going on with that present value of the exercise price. Just take your financial calculator, set it to 365 periods per year, so you're using daily compounding, and then 40 as your N. Our risk-free rate was 4%, so set that up as your interest rate. We're solving for the present value. The payment, there's no annuity stream here, so we're going to zero out the payment, and then we'll enter our future value, which is our strike price of 60. Solve for PV, and that should come up real close to the 59.74. My guess is it's going to be within a penny of that 59.74, because all we're doing here is finding a present value using continuous compounding. Daily and continuous compounding are going to be very close. So 40.63 minus 36.91 gives us $3.72. Now, if you're watching this video, I strongly encourage you to go through the calculations, practice this, and make sure that you can get the answers. Next, we're going to have the value of the put. But I'm going to stop here and save that for our next video. So in the next video, it'll be real short. We'll walk through that value of the put calculation.
Hello friends, this is Vijay Bamvani here. I am in this video going to share one more indicator with you from our in-house statistical trading model, the IBEX. I had promised my friends, my viewers, that I would be opening the door.
Okay, students, so that's that. That's a Black Scholes. Okay, students, so that is all we've got about the Black Scholes formula. All right. Any questions? You already know about it. So this underlying video would have kind of explained to you the implications of all of it.
Sir, I don't have any questions from my end for now.
Yeah.
But I'll just try to go through this once again once I get the recording. And if I have any doubt, may I come back?
Yeah. You can WhatsApp me, no issues.
Sure. Thank you so much.
Anything else, students?
No, sir.
Okay, now we'll go to Sensible and we'll see what their market outlook is. That's something I missed earlier on. We'll do that as well. Okay, so this was the analysis for yesterday. I don't think these guys have updated yet format. So look at videos. Okay, so anyway, this is what's from Friday. Let's have a look.
So number one, chart Nifty of what the market does, right? So let's get started in earnest because we're already kind of late. So number one, chart Nifty. Nifty has sustained above the 100 DMA and it has invalidated the pattern which was formed yesterday, which is a evening star doji. Right, so it's not confirmed. Evening star doji is gone, so now the market is looking bullish. However, if you look at it in a shorter time frame, the only thing we know for a fact is that this is strongly in an uptrend. Why? Because 50 DMA is above 100 DMA is above 200 DMA, sorry, HMA. 50 hourly moving average is above 100 hourly moving average is above 200 hourly moving average, and the stock price is above all four of them. And now there's a very clear hourly channel running. Now this Nifty is going to follow this channel, right? Now, obviously it is testing the top of the channel, so you have to be careful, but there is no doubt that the trend is up, right? So the trend is for sure up, but you have to be careful that it is the top of the hourly channel. So now there are three conflicting things at play, right? One is the short-term trend is up, no questions. The long-term trend is down because we still haven't formed a higher high, right? We have not confirmed reversal. This is Nifty. So this is not reversal. So you have to be careful. Also, now it's not a good thing to buy at the top of a channel. You can do it if the channel breaks and there's a breakout, right? So you can't buy at the top of the channel because the channel top is a resistance. You can only buy if the resistance is broken and if there's a breakout from this channel, or you can also buy if it goes below and then there is a price action which shows that it is going to again test at the top of the channel. So there are only two plays here. If the channel top is broken, buy. If it falls below, and if you get an entry at let's say 16350 or something with the price action which supports uh, bullish momentum, then you can go long again. But at this point, as of now, this is not a buy simply because we need a break above the channel to continue buying. This point surely buy, this point surely buy, this point wait for the break of the channel, right? So that is point number one. Let's look at Bank Nifty. Bank Nifty, it's a little tricky for me because 200 DMA is a level Bank Nifty has always respected. So I don't really want to go against the 200 DMA of Nifty. So I'm at a little bit of a wait and watch here. I'm confident about long Nifty. At least I'm confident about not shorting Nifty, right? But I'm not very confident about long Bank Nifty for the simple reason that 200 DMA is not going to be very easy to break for Bank Nifty. And finally, USD-INR charts. There's a dip today, but again, the long-term trend is up. There's no reversal signal, so it is still a long. Now let's look at open interest charts of Nifty. So we made a change now. We always look at open interest chart of Nifty like this, not on the option chain anymore. So 28th July expiry, which is a monthly expiry, equal number of calls and puts at 16,600. However, humongous puts at 16,500, some calls at 16,600, lot of puts at 16,500, bullish open interest of 1.3. So I would say that it is likely that we'll see upward momentum. Also, if you look at the last few days, 16,500 has witnessed a lot of call writing. So largely PCR option chain, the OI related data is all screaming bullish. Now let's go to FIDI data. This gap has narrowed further. The puts are catching up with calls. Sorry, the calls are catching up with puts. FI bought 20k calls, sold 30k puts, which is super bullish. Bought 20k calls and sold 30k puts. Both of this is bullish. FI futures data, 2500 crore futures bought bullish. 1800 crore stocks bought bullish. So net right, the market is bullish, and a break above the early channel can trigger upward momentum. A dip with a bullish price action is also a buying opportunity. Basically, as long as we are inside that channel, inside the small early channel, it is a bullish trend and not a bearish trend. So what is my trade? Buy on dips with bull call spreads. I will not say buy on dips because we are saying strategy. Long Nifty on dips with bull call spread, short puts, bull put spread, etc. Why? Because the channel has to be broken, right? If early channel broken, then buy calls, buy futures with tight stop. Again, so basically this is a very nuanced one, because see, I agree that market is bullish and all that, but you can't go long something at a short term resistance inside the top of a channel, right? If it is broken, yes, you can probably be long even till 17,200, right? I mean, sorry, I should not predict the level, but 200 DMA is at 17,200, right? So it can go quite a bit up. There's no question about that at all. But the important point here is that you cannot be going long into a market when it is facing a resistance. So what's my strategy? I'll wait here to see if there's a buy on dip setup. If not, if it breaks, I'll again go long till wherever the breakout lasts till, right? But at this point, I'm going to be a little cautious because this is running into the top of the channel, right? So what do? We can do theta selling on the weekend on put side predominantly, slightly OTM puts. 16,500 is forming a great support, as you can see from the charts. So that's okay. But you have to be careful, because if it pulls back on this channel, it can go to 16,300 levels also inside this channel. Worst case, it can even test 16,000 levels, but that I think is very unlikely. But as of now, Nifty story is the story of this channel, right? So this is our analysis for today. We'll see you again on Sunday night. Very late we started, so I'll stop very late. Thank you so much, guys, for joining. We'll see you again tomorrow. As usual, please take care and keep your capital.
तो दोस्तों वीडियो शुरू करने से पहले एक छोटा सा अनाउंसमेंट.
Okay, students, so that's the view, right? So the view is bullish, as you can see. Short term definitely looks bullish. As I told you, not many bearish cues. Other than there can be a pullback. I think there will be a deeper pullback, probably to 16,3, 16. My guess is it may extend all the way to 16,000 also. And then probably a move back up to 17,000 is possible, I think. So So that's the overall. Any queries, students, on what you just saw? Yes, no?
Nothing from my end, sir.
No,
Okay, fantastic then. Okay, so in options, there is something called the Greek letters. Options have some Greeks associated with them. Each one is unique. Yes. So, so we will get into what these things are, and then we will see how traders use it to position in the option market. So delta, option delta is a very important thing. So delta is the rate of change of the option with respect to the underlying asset. So how the option prices change with the stock price. If you graph it, the slope of that is your delta. So delta will be positive for calls and negative for puts, minus 100 to plus 100. So for deeply in the money puts, it will be the lowest, and it will be deeply in the money calls, it will be the highest. So 100 will be for very highly in the money calls, and minus 100 for very deeply in the money puts. So sometimes traders do delta hedging. Yeah. So they will always want the delta to be neutral. So buy high delta, sell low delta, and balance your book. So how can you do delta hedging? So have a look at this. So delta neutral strategy is nice because you can always optimize, position yourself and balance your portfolio. So if delta is 0.4, how many shares do you require to hedge if you want to do a delta neutral strategy? So delta into option contract into contract size would be your number of shares to hedge. Okay. Then, so how does this benefit us? So this is an example of a delta neutral strategy. So when the stock rises by 10 prior to thing, option will rise by 10 into 0.4 or by 4 rupees. So earlier option price was 22. So 22 plus 4 is 26. So gain in stock is that, loss on options. So when you have a stock option portfolio, you can perfectly hedge this. So basically you are hedged. So delta neutral strategy is when you are not sure about which way the market, if you think that the market is going to fall or rise, you want to develop a hedging strategy. So, so that will help you become delta neutral. So anyway, gain in stock will offset your loss in options, and similarly gain in option will offset the loss in stock. So basically you're having a stock and selling an option, that kind of a thing. Covered call writing strategy. Okay. Now, theta is measuring your time decay. Remember, as we get closer and closer and closer to maturity, what will happen to your option price? Yes. If the same value of stock is there, what happens to your option premiums?
will reduce.
So it declines because the time premium is decaying. So the decay is measured by theta. Is that clear? So how much time decay is happening is captured in theta. So you can see here a theta and how it decays. Okay, gamma is another useful, very useful tool, right? Gamma is the rate of change of delta with respect to the price of the underlying asset. Now, why is gamma useful? So typically when the underlying asset shows positive gamma, it is usually in an uptrend. Okay. So typically in an uptrend, you always have positive gamma happening. Right now, what is happening is the gamma is negative for most market indices in the US. Yes. So any bounce that has happened is being sold. Okay. So people look at what the zero gamma level is. Okay. So if the zero gamma level is exceeded, then the trend can change. For right now, gamma is negative for many of the market indices. When it becomes positive, okay, there you can experience trend changes. Hey, by the way, one another thing I wanted to tell you is, show you guys, is that on Nifty, hold for a second here. You may or may not see it on the daily chart, but the Nifty's 200-day moving average has been declining for the last 1 month or so. So you can see how that red line, guys, that red line, you see there, it's coming down. So the long-term trend also is changing to the downside. So this red line here will be very big resistance if the Nifty were to go up. So as long as gamma is positive, yes, we are happy. But when gamma shifts to negative, then so when as long as gamma is positive, if the trend is up, it's a very good time to buy. When the gamma is negative, and if the market is trying to bounce, unless the gamma goes positive, you're better off staying short. So right now the market is at an inflation getting closer to that break-even gamma zero level. So if it manages to go gamma positive, then that's a good thing. The trend may continue up. Otherwise, it may reverse. Okay. Okay. Now, another Greek is the rate of change of the value of derivative portfolio with respect to volatility. So this is another interesting element, Greek, which is essentially mentioning how the value of a portfolio, derivatives portfolio, changes with respect to underlying volatility. Okay, so how do you manage this? So delta can be managed by taking a position only in the underlying asset. So to adjust gamma and vega, you need to take a position also in the, you should be able to take positions in the derivative itself, in the option itself. So rho is an interesting derivative. It it is it is the rate of change of the derivative with respect to interest rate. Normally, this doesn't change much, but of late, interest rates have been going up and down like anything, mainly going up non-stop. So that can impact put and call options, and row measures that. Okay, so how do traders act? So good traders ensure that their portfolios are delta neutral. Remember, I was talking to you about a delta neutral hedging strategy. Yeah. So whenever the opportunity arises, they increase their gamma and vega. They improve their gamma and vega. So for larger hedge portfolios, if you do these, keep doing these practices, then you can hedge less expensive. So make your portfolio delta neutral. When the opportunity rises, improve your gamma and vega. Yes, you want to be in positive gamma and vega. Okay, students, so let me just see if I have a video for you on this. I'll we'll play a bit of this. It's a nice little video here.
Hey everyone, this is Kirk here again at optionalpha.com, and in this video we're going to go through options pricing and the Greeks. Now I can tell you honestly, this is actually one of my favorite parts about trading. I'm just a numbers guy by nature, and I can tell you that this is by far the number one distinguisher between those people who are successful in this business and those who aren't, is understanding how options are priced, understanding the Greeks, how implied volatility and time decay and all of that stuff impacts an options price. Because if you understand that, then you'll understand where we get our edge in trading. And we're going to be going over this a little bit more in some other video tutorials further down in track 1. But today we're going to dive really deep into options pricing so that you guys have a clear understanding of it. So first of all, trying to predict what will happen to the price of a single option or position involving multiple options as the market changes can definitely be difficult as an undertaking. So it's really hard. It's easy with stocks, right? You know what's going to happen with the value of a stock because you can see it visually, right? That the stock value goes up or the stock value goes down. With options, there's so many different components that factor in. It's hard to understand sometimes what is really impacting the value of that option. So like we said, because the option price does not always appear to move in conjunction with the price of the stock, it's important to understand what factors contribute to the price of an option and the effect that they have. Option traders often refer to delta, gamma, vega, and theta of their option positions. This is collectively called the Greeks, and they provide a way to measure the sensitivity of an options price to quantifiable factors. Now, it's really important that you realize immediately that the Greeks do not determine pricing, and this is a big misconception that people have. Greeks don't determine pricing. They just reflect what could happen in option pricing changes for moves in stock, implied volatility, time, etc. Okay, so Greeks are forward-looking. They are not a determinant of option pricing. They basically tell you if this happens, then the price of the option should go down or up by X. Okay, so they're like little levers. So if you push this lever, then you'll get this reaction. If this happens in the stock, you'll get this reaction. And that's a big misconception that some people have. So again, before we talk about the Greeks, let's dive a little bit deeper into overall options pricing, which builds on the concept you've already learned earlier in this course and track 1. All right, so here's the deal. And the way that I always think about it is like this, and this is what we kind of created here for you guys, is that options pricing. So the price of an option is basically broken down into a couple different categories, and then we'll kind of get a little bit further and deeper into the Greeks. Now, we've already talked about intrinsic versus extrinsic value. I think we did that on the last video or the previous video inside of track 1 here, talking about in the money, out of the money, and at the money options. But basically, you can break down an options price into 2 broad components, and that is intrinsic value and time value. Intrinsic value, again, being the value of the option right now if it were to be at expiration. So does it have any value right now based on the spot price or the stock's price and your strike price? Meaning if you have a 50 strike call option, so your strike price is at 50 and the stock right now is at 55, you know that you have $5 of intrinsic value in that option right now because you can buy it at 50 and immediately sell it at 55, okay? So that's the first component of option pricing, is this intrinsic value. And again, that's just simply looking at the difference between the stock price and your strike price, whether you're on the call side or the put side. Now, the other component of options pricing is time value. Now, this is the one that always kind of trips people up. Most people get intrinsic value, but this time value aspect really has a lot to do with how option prices fluctuate in addition to the movement in the underlying stock. Because we know that the intrinsic value is going to move as the value of the stock goes up and down. That's just a straight linear relationship. But this extra component here, this time or extrinsic value, that's a little bit different. So that factors in things like time to maturity. So how long is it before expiration? Typically, options that have a long time before expiration are more highly valued because there's a long time for that contract to be out there. Options that have a low time until expiration are typically lower valued, all things being equal. Volatility, again, this is the key right here. I can tell you right now, if you've watched any of our videos here, or if this is the first video that you're watching here at Option Alpha, I am telling you right now that volatility is the key to everything that we do here as a trader and trading options. It is the number one most important thing that you can master. And volatility, when it comes to options pricing, just basically means that when the markets are more volatile, so when there's high volatility, then option pricing is high as well across the board. Calls, puts, everything on both sides. When there's high volatility, option pricing goes up as well because a rising tide raises all ships, meaning that when the markets are really volatile and swinging back and forth wildly, then each strike price has a better chance of being hit. When volatility is really low or dropping, then option pricing as a result goes down. And when markets are really low in volatility, meaning they're just kind of moving sideways or not really, making those huge moves like a high volatile market. In low volatility markets like that, then option pricing is low because then those further out of the money strike prices don't have a high chance of being hit. The market just doesn't move all too much. Then the last thing that really affects the value of an option is the rate of interest or interest rates. This is rho. We don't usually talk about this, so I'll kind of briefly cover it right here, but we don't usually talk about it as kind of like the main 4 Greeks. And rho really affects options that are really far out in date. So just like time to maturity and just like volatility, as the contract expiration is further and further out, we're talking 6 months, a year, 2, 3 years out, then interest rate impacts will have a bigger impact on the value of that option. For what we do here at Option Alpha and what most traders do trading inside of 60 days, the impact of interest rates is non-existent almost. So we don't really cover it as kind of like a main Greek, but it is there, just so you guys know. Okay, so that's kind of like the basics for options pricing. Now let's dig a little bit deeper into the actual Greeks, and we'll kind of relate this back to the things that we just talked about. So again, options pricing broken down into those 2 main categories, then all the ones below. Now we have the Greeks, okay? And again, we have basically the 4 major Greeks, delta, gamma, vega, theta, and then we have rho, which is the interest rate one as well, okay? Don't want to discount that. Don't want to assume that's not there. It is, but doesn't really impact shorter maturity options. So again, delta is now going to give you and show you that relationship for intrinsic value. Okay, this is basically what delta does. It gives you the relationship to how much money you're going to make for that particular strike price based on any particular movement in the underlying stock. And again, we'll go over each of these individually with a lot of examples too. Okay, gamma doesn't really have a connector here, but gamma is related to delta. So gamma is considered basically the rate of change or the acceleration amount of delta. So it basically shows you that next dollar amount, you know, how much more are you going to make for that next dollar, and then the next dollar, and then the next dollar. Vega is very easy to remember. Vega and theta are very easy to remember because I always think V, Vega, V for volatility. So Vega is going to tell you what the impact is on that option for a 1% change in volatility. And again, that's all things being equal. What happens to the value of that option should volatility go up or down by 1%? T for theta is time to maturity. This is basically going to tell you how much the value of that option decays every single day as it gets closer to expiration. Remember, options are wasting assets. As they approach expiration, the theta decay, as it's called, or the time decay, starts to accelerate as it gets closer to expiration. Time is running out. The clock is running out. And so the value of the options go down dramatically as we get closer to expiration. And then again, we have rho, which is the rate of interest. Okay, so let's get a little bit deeper here and talk a little bit more about delta. And we'll go through delta, gamma, theta, and vega and go through some really clear examples using some live pricing at the time I'm doing this video. Hopefully that really helps kind of clear things up for you guys. So let's first talk about delta. Delta is one of the biggest ones you'll probably hear. We talk about it here generally, not too often, but we will talk about delta a lot, and you'll definitely see it on your broker platform. Now, delta is the amount an option price is expected to move based on a $1 move up in the underlying stock. Now, the key here is that the delta is always based on an upward movement of the stock. It's always based on a $1 move, no matter if it's a $500 stock or a $2 stock, it doesn't matter. It's always based on a $1 move and based on a $1 move up. Now, naturally then, call options have positive delta between 0 and 1, meaning that if the stock moves up, that is always good for long call options. And then vice versa, put options always have a negative delta between 0 and -1. That doesn't mean that they are bad. It just means that when the market is moving up, then it negatively impacts put options. But when the market moves down by $1, then it would positively impact a put option. Okay, so that's basically the textbook definition, if you will, of delta. But let's really kind of dig deep here and look at some examples. So this is my live broker platform. Right now we're looking at GDX. Why GDX? Because I just typed it in and we're just looking at it. Okay, the stock right now is trading, and its live time is trading at 2060. Okay, this is an ETF for gold. So it's live time trading at 2060, and I've got two contract months open. I've got the April expiration and I've got the May expiration. Now, April expiration has about 24 days to go. May expiration has about 59 days to go. Okay, so this is going to help us show the differences in how some of these numbers are going to shift and change and move as we go further out in expiration or closer in expiration. Okay, and then again, we have some of the weekly contracts that are in between here as well. All right, so let's actually go in here and start looking at some deltas. Now, the first thing I want to do is I want to look at these 21 strike call options for both April and for May expiration. Again, I'll just highlight it here so you can see it a little bit more clearly and focus in on it. But inside of our platform, at least on Thinkorswim and most broker platforms, you have all the different Greeks here: delta, gamma, theta, vega. You can change these things. And again, we're working on just the call side right now. Now remember, delta is going to tell us how much money we make or lose based on a $1 move up in the stock. So right now, the delta of the 21 strike call options is 46.46. And what this means is that if the stock goes $1 higher from where it's at right now, so from 2062 to 2162, all else being equal, all things else being equal, then this value of this option contract is going to go up by $46. Now, the current value of this contract is about $74. This is a bid and the ask spread here. So it's currently valued about $74. So if the stock goes up by $1, then this option contract should go up by $46. Okay, so again, you can see the impact that delta has. It kind of gives you a barometer for how much money do I make for every $1 move up in the stock. Again, now as we look out towards the May expiration, you can see that there's a bigger impact in May for the same underlying move because there's a little bit more time left until expiration. So again, still the same $1 move up in the stock from where it is right now, 2060 up to 2160. That gives you a $49 increase in the value of the option. Okay, those options out of May are a little bit more expensive because of a bunch of different factors, which we'll continue to talk about. But those options have a lot more time decay, a lot more volatility baked in, and are going to profit a little bit more from a quick move up in the underlying stock. They cost more upfront, but they're going to profit a little bit more, a couple dollars more, for a $1 move up in the stock. Okay, so that's on the call side. Now let's look at the put side of the trade at the same 21 strike puts. So the same 21 corresponding strikes, but now on the put side. And you can see here for Delta that all of the deltas are negative. Now, it doesn't mean that you're always going to lose money. It's just remember that Delta is telling you how much money you make for a $1 move higher in the underlying stock. If you owned the April 21 strike puts and the stock moved up by $1, the value of your contracts would go down by 54 cents. So right now they're valued at about $1, 112, 113. They would go down by $54. Now that also means that in the reverse, you would make money. So if the value of GDX actually went down by $1 instead of up, if the value of GDX went down from 2060 to 1960, then you would actually make $55. Okay, so it's just the complete opposite. If the value of the stock goes down with put options, then you make this delta, which is 0.55. Okay. On the call side, again, the same relative thing is going to happen here. You can see that the delta is negative 51 on the 21 strike puts for May. That means if the value of GDX, the stock itself, goes up by $1, we lose $51. If it goes down by $1, we make $51. Okay, so hopefully you can see how that relationship starts to interact with each other. Now, one thing that you'll want to point out is that obviously the value of in-the-money options is always going to have a higher delta than out-of-the-money options, okay? And again, remember that delta is more of your intrinsic part of options pricing. It basically bakes in the intrinsic value of those options that are already existing, meaning how much money could you make if expiration was today. And you can see that any options that are in the money, both on the call and put side, any options that are in the money have higher deltas, whether they're higher negative or higher positive. They generally have higher deltas approaching 1 and -1, which is basically parity with the options. Any options that are out of the money usually have lower deltas because they're not going to be as responsive to a dollar move in the stock as something that's in the money. So if you bought a 23 strike, let's say call, that's way out of the money, and a dollar move up, it's still not going to be in the money. So a dollar move up from the stock of 2060 up to 2160, you're still not going to have your stock price above your strike price or have an option that's now in the money. So that option is going to be less responsive and is going to profit less than something else that is a little bit closer in. Again, these options are always cheaper, so the market is always fair and efficient with how it prices its options. All right, so let's move on here and talk about gamma. Now, gamma is a little bit different. Remember, gamma is going to be related and kind of tied into delta. Gamma is the rate of change in delta based on a $1 change in the stock price again. So if delta is the speed at which option prices change, or how much you make or lose, then you can think of gamma as the acceleration. So options with the highest gamma are the most responsive to stock price changes in the underlying security. The way that I think about gamma, because I know it's hard and I'm trying to give you guys as much information as possible. The way that I think about gamma is I think about gamma as the additional profit or additional loss for the next dollar. That's how I think about it. And so let's go back here again to GDX and we'll kind of use an example here. Okay. So if we were looking at, let's say, these options now, we'll kind of just move around here to challenge you a little bit on option pricing. So if we were looking at the 22 strike call options in April, the delta for these options is basically 30. All right, so let's round up so we have round numbers here. It's 29, but it's basically 30. Okay, so that means that if GDX goes up by $1, the first dollar from 2056 to 2156, you make $30. Okay, If it goes up another dollar from there, so from 21.56 to 22.56, you'll make another $30 plus the additional dollar is going to get you another $15 of profit. So the first dollar that you make, or the first dollar up in GDX, you basically take in $30. The second dollar, or now $2 higher, you take in an additional $45 for that move higher. Okay, so you can see that as the stock rallies, your profit potential, at least with call options, as the stock does rally in your favor, you have an opportunity to kind of compound a profit here in a small snowballing fashion. Okay, and again, it can work in the complete opposite. So if the stock moves down by $1, so again, let's use this example here. It works complete opposite. If the stock moves down by $1, you lose $30. If the stock moves down by another dollar, so now it goes from 20.57 down to 19.57 down to 18.57. Then you lose another $30 plus another $15. So now you're losing even more money as the stock goes down as well. Okay, so I don't want you to think that it only works in one direction. It's definitely a two-sided market. Obviously, it works in both directions. And again, that rate of change is just showing the incremental impact of the delta and the underlying stock move. Now, in this case with gamma is always positive, and it just means the additional money made or lost. So on the put side, if you're looking at, say, the 22 strike puts, if the stock moves down by $1, you make $71. Remember, on the put side, we want the stock to go down, and that means we make money. If the stock goes up,
Students will continue this in the class. The reason I played this video is some examples. Is nicely walking you through examples of how gamma and delta and all those things move option pricing. So we'll continue this video in the next class. Now, Kirti, can you present your idea? I will stop my screen share.
Sure, sir.
Go ahead. How is your new job with Wells Fargo?
Yeah, like you mentioned, sir, I'm in the settlements. So
Okay.
basically derivative settlements, and they're training me on all the 4 asset classes.
Oh, fantastic. So any of this stuff is helping you?
Yes, to an extent, yes. But yeah, I'm trying to get used to the softwares and
Oh, yeah.
so that's the main thing. And yeah, it's actually nice.
Oh, fantastic. Yeah. Anyway, if you have any doubts and you need any help with anything, you contact me one-on-one. No issues.
Sure, sir. Thank you so much.
And the same goes for every one of you guys. In case you need anything additional and you have queries, message me. Yes, Mahesh?
Yes.
Yeah. Okay. Go ahead. Kirti, share your screen and explain to me. I think Chavi is disconnected for some reason. So
Is it getting shared
yeah.
now?
Yeah. I can see.
So basically, sir, I tried this one trade on TradingView. Hello.
Yeah, I can hear you.
Yes, this is on 21st, that is like day before yesterday. Hello.
Yeah, I can hear you. Go ahead.
Okay, this is on 21st. So I usually place a trade on TradingView. I mean, recently I started doing that, and this is investing.com thing. I used like 4 indicators, that is MACD, VWAP, then EMA, that is exponential moving average 5 and 20.
Okay.
So based on the analysis, like so over here I was able to see that blue line over here was overlapping the red line in MACD.
Yeah.
Hello.
Yeah, go ahead.
And the stock was actually overvalued at that point, at that exact moment. So it was going on an overvalue. We can see that, you know, the candlesticks are above the green, neon green kind. And when it comes to exponential moving average, it was 5. I mean, exponential moving average 5 was over the 20. So based on which it was like a sell signal for me. I mean, and I took a sell call, I guess. Yeah. So I the phi is the number of quantity or the lots that I put. So
Yeah.
this is the profit that I got basically. So
Very nice.
the reasons are MACD had blue MACD had crossed the red, and like I said, the phi had overlapped the 20 EMA, so it's a sell signal and overvalue of any stock, which means that it will come down at some point, like very soon.
So I guess you waited till the price came below the VWAP, right?
I couldn't wait for long because I had to go out, sir. Like I had to short it a little early, but later on, I mean, over here we could see that, I got just 75 or something as the profit over here, 75 or $72.
Yeah.
It went till $150.
Yeah.
So within like next 1 hour or half an hour, it went till $150. Like if I had carried it forward, it would have been 150.
Yeah. Yeah.
So this is the main thing. I tried another one,
Yeah.
but
Go ahead.
it's actually undergoing I mean, I underwent a loss, like a huge loss over there. I can
Yeah.
show you that thing. So these are the existing stocks that I have, like ongoing. It's still in position.
Yeah.
So I've taken a long for this because I was able to see that when it comes to TVS, like this, I placed this order on 21st.
Yeah.
21st. So I was able to see that, this stocks are undervalued with the same criteria. So I haven't tried with any other new criteria for now. So it is kind of undervalued, and I could see that 20 EMA was over the 5 EMA. And when it comes to MACD, the red line was over.
Yeah.
Okay, am I audible? Okay, that's good.
Yeah.
So I was able to see that, red MACD was over the blue MACD. So at some point I felt, okay, I can take a long over this, and I went for a long. And yeah, it is actually increased on the very same day. There was a profit of just 0.03. But yeah, within next 48 hours, it has increased to 0.02. It's very less, but yeah, when I'm seeing on a long end, yeah, I think I might have profit within another 20 days or so. I have to keep on looking into it. Hello.
Yeah. Go ahead.
Yeah, yesterday I placed an order on euro currency, euro INR. So this is still undergoing a loss. I mean, I don't know. I feel like currencies are a little too slow, sir. I mean, I don't know why. I mean, the movements are really, really slow, and it's like very minute.
So the thing is, you've taken Euro INR, correct?
Yes.
Both Euro and INR are moving against the dollar to similar extent.
Okay.
So, but INR has fallen less compared to the Euro recently. So, so Euro USD or USD INR will probably move a bit more than this.
Okay, Euro ISD.
Euro USD.
Okay, USD, yeah.
Yeah, or USD INR.
Okay.
These things will move a lot more than the one you have chosen, I think.
Yeah. So over here, like I felt the market is a little too stagnant. It's like very minute when I saw. So yeah, I don't know. I thought like, let me have a look. It's not like, anyhow, we are here to learn things. So let me have a look. That's not an issue.
Yeah.
So other than that, I think this was the major loss that I faced yesterday.
So this was crude oil.
No, this is not crude oil. This is crude oil. This is. I might be having a screenshot. I initially tried to take a position in a gold, in the other website that you used to say, I forgot the name, sorry.
IQ option, yeah.
Yeah, IQ option, but I couldn't get a very good result. Like we had discussed earlier that it would go a little, it would raise, but yeah, it didn't. So I kind of, squared it off.
Yeah.
So it's Mahindra and Mahindra, I hope, the one
Yeah.
which would be a loss.
Oh, okay.
No, it's not Mahindra and Mahindra. Okay, I've not taken the screenshot. I'm really sorry.
That 100 price looks like crude oil. That's why I asked you.
Okay. This one.
Yeah.
Okay. The thing is, I tried crude oil here, like the one on 21st. I'm really not sure about what I did yesterday. I really I wanted to try something like with some currency is what I remember.
Yeah.
I want-
there is options to remove balance before and balance after. Then action will use to.
Sorry?
There is an option, right?
Yeah.
After the actions, option
Okay.
symbol.
Yeah.
Remove the balance before and after. Yeah,
It's crude
becomes
oil.
crude.
Yes, sir. You're right.
Yeah. I could tell from the price only that it is crude oil.
I mean, how was that you were able to say that?
I know all of them in my head, most of these,
Okay.
because I
So-
watch them pretty much every day. So, yeah.
So this was a major thing. I kind of took a short position, but it went the other way around yesterday.
Had you held, you would have made quite a bit of money, I think. I think the trend is down big in that.
Okay.
Sometimes
So-
what happens is it may be very oversold and it will bounce and then it will crash again.
Okay. But
Possible.
what I noticed over there is like MACD and when it comes to value of stock, it was coming to a nil. Like MACD, both the lines were coming to a 1 point. It was going with a stagnant line. Like together, they were overlapping at 1 point. And when it comes to candlesticks, were almost similar to the VWAP. So I thought, okay, let me short it right now. So that's the reason I kind of faced a huge loss here. This is M&M. I just wanted to try if it's working or not. Like that was the very first just stock I took before this $75 thing. So that's it for now, sir.
So very good. You can write this all up for your assignment. Looks like you've already completed it, most of it.
I am trying to figure out like if I can try with new stocks. Like for example, like Forex is something that we have never tried, like what I tried yesterday. So I'm trying to do something, get my hands into something new so that I get a idea about it and I can ask if I have any doubts. That's it.
Yeah.
So that's it for now, sir.
Okay, fantastic. Thank you.
Thank you.
Sir, I didn't take screenshots of my trades.
Go ahead.
No, I'm saying I didn't take screenshots of my trades I placed till now.
You can take it and make the report later.
Actually, you said screenshots for option strategies, so normal trading I didn't take.
You can now do and take again. Still time is there now.
Okay.
Or like if it's like which is the website that you use? I mean, which app do you use, Mahesh?
What now?
For which one?
Is he using TradingView or option strategy?
Either way, I think you can look at the
Because
history.
generally there'll be a arrow mark over there. Like if you had placed any trades, generally they show like let me show you that.
You can just go back and look at it, Mahesh. It may be still there.
Yes, sir, it will be there.
You can recapture it, no problem.
Yeah, okay.
Okay, students, any other questions you guys have on anything discussed so far?
So no questions for now. Is there any feedbacks that you would like to give in order we can improve?
No, I think this demo trading is important. You can keep doing that. Do watch the videos on these topics in case, in fact, watch the recording of the session. That will help you quite a bit, because even if you watch the videos, you should be able to place it in context. So the session recordings are being sent to you, right?
Yes, sir.
Yeah, please go over them whenever you can, because everything is in context in the class. So that's why I don't send the videos beforehand, because when after class, if you can get the video in context, it would be better.
Sure, sir. Sure, we'll get into it. Thank you.
So if there are no more queries, I'll wind up and we'll get back to class. Please do put a reminder in your group saying that ask the students to work on their assignments. Okay, students, then have a good week. We'll see you next Saturday. We'll leave you a little early.
Sure, sir. Thank you. Have a great weekend.
Thank you. Thank you. And if there are any queries on anything, just do WhatsApp me in between. No issues.
Sure. Thank you so much.
All right. Bye.
Take care.
Thank you.